Thank you. Good afternoon, everyone. Can you hear me okay? Look, thank you for taking the time this afternoon. We're going to talk about a couple of things over the course of the next 20 minutes or so. Can I just ask a question though? Who knows who Stripe is? Quick show of hands. Okay, a couple. Okay. So for those that don't, we are a 7-year-old San Francisco-based payments company. And so over the course of the last 7 years, what we've been doing is taking what I would describe as new world technology, cloud, APIs, etc., and really bringing a new kind of service to the way businesses go about processing payments on the internet. So surprisingly, I'm actually not really here to talk about Stripe today. We can perhaps save that for another time. But just as we go through the material today, just kind of keep in context that that the angle that we bring to this is really through the lens of payments and the way that payments on the internet have been transforming over the course of recent years. I think if there's anything that we know to be true, that's obviously that the world of online commerce is changing fast. We also see that consumer expectations, as we all know, with the way in which retailers interact with consumers, is also changing fast. If there's one thing though that I think perhaps that's changing faster than all of that, it's this notion of kind of the platform economy and the way that platforms or online marketplaces are taking greater and greater share of online commerce. And I think there's a couple of substantial reasons for that we'll go through a little bit today, not least of which being, I think, is the kind of increasingly important role of the developer or the software engineer inside of organizations today. So we're going to focus really on those two topics over the course of the next 20 minutes, platforms and the increasingly important role that the developer is playing in enabling their success. I think to tell this story properly, though, we have to go back necessarily a little bit in time, maybe a couple of hundred years, to London, in fact. So it's convenient that we're located here. To what you can see on the slide, which was the world's first department store. Okay, so appropriately named Harding Howell & Co.'s grand fashionable magazine. And so this was the place where well-heeled, newly affluent Londoners, benefiting from the Industrial Revolution, flocked in droves, to spend their money. And a department store in this era really had just a handful of departments, and it sold things like hats and clocks and jewelry and furs and fans. But actually, if we're going to tell the story truly properly, we'd probably want to go back maybe actually another couple of thousand years to the Middle East, 500 BC-ish, in the domain of souks and bazaars and marketplaces, in the case of places like Morocco and others. And the thing to think about here is really the premise of whether it's the department store or the bazaar, really what they are environments or forums to bring together merchants to trade. And so whether they're trading amongst themselves, whether they're trading and selling their wares, be it textiles or animals or food to consumers, this is really the genesis of where the modern day department store came from. And so obviously that's evolved rapidly over the course of the last couple of hundred years, be it we have Harrods, Selfridges, Harvey Nichols, everything in between. But what we know is that the fundamental core of what a department store represented was a marketplace, bringing together merchants or retailers of goods and consumers and giving them a place to exchange. Now, the fate or the current state, I guess, of department stores these days. We all know they're going through some troubled times. House of Fraser, just a month ago, came close to collapse. Just this week, be it Debenhams or John Lewis and others, there's some news around kind of the current state of department stores. Again, we're not here to kind of wax about the future, what the future of department stores might be, rather than to talk about the concept of what a department store is, and that's a platform or a marketplace on which commerce takes place. And so, just like retail, I think we need to think about that concept of the marketplace in kind of a constant state of flux. But at its core, this is what it kind of sets out to achieve. Whether it's the souk of 2,500 years ago, or whether it's the 21st century kind of incarnation, of the platform or the marketplace in the form of Amazon, the premise is still the same. Amazon, we know, is a little bit of a unique example, and I'm sure it's been discussed to death over the course of of this conference already. But 10 years ago they were the 47th largest retailer in the world. Today they're the third largest behind Walmart and Alibaba. Their market cap, just as recently as last week, just edged above $1 trillion for the first time. And so whether they're in kind of an edge case or not, what they do is kind of represent the modern incarnation. And with these other channels from Alexa to drones to Prime and so on, many are asking the question, well, how is it that the modern day marketplace or the modern day retailer can actually compete? Actually, we believe that quite a few are, if the truth be told. I've flashed a couple of names up here that you may recognise. From ASOS to Farfetch to Wish, some of those local, some of those international. But really what they represent is kind of the new age mobile first marketplace that actually are pretty successfully starting to carve out a niche against the backdrop of the increasing dominance of somebody like Amazon in this domain. And I think it's important to think about these in context of what they represent and the basis on which they're differentiating against some of the larger scale kind of competition that exists. And that basis for competition for them is really very much around the segment that they serve, or the category that they serve, I should say. In these examples, it's fashion. And the means of service that they provide to engage with their customers, and some of the technology, the mobile or the API-oriented approach that they're taking to building a technology-enabled service and delivering that to consumers. So we kind of coined this phrase that platforms are eating commerce. It's an extension of the idea of that software is eating the world. But it's not actually just constrained to fashion as a category, or indeed kind of traditional retail as we think about it. Think about food service delivery. We see some of the similar trends start to hold and take force. If we cast our mind across to the world of kind of finance, or in the case of these examples on the screen here from Kickstarter to Crowdcube, we're really talking about the crowdfunding world. We're still talking about platforms or marketplace where buyers, in the case of someone like Crowdcube, those buyers are the backers of projects or investors, are being meaningfully connected with the sellers, i.e. the entrepreneurs that have ideas or projects for which they're seeking funding. And of course, there's the very off-cited example, of the transportation industry and what Uber and Lyft and, Grab or Gojek or Didi and all of these others around the world, are starting to do, to the world of marketplaces. So actually, we maintain that there's actually a fairly sizable basis for kind of differentiation in some of these industries that have been disrupted, but the role that platforms and marketplaces are playing, are not to be underestimated. And in fact, this is a statistic that was coined in 2015 that we're actually seeing bearing out to hold true, and that is to say that 40% of commerce online by 2020, only a little over a year away, is going to be conducted across platforms, as opposed to directly from brands or retailers or service companies, directly to the consumers or the consumers of those services themselves. And so I guess the question is, well, kind of why is this? Why is it that some of these platforms are starting to have some outsized success? And I think the very simple answer to that is that the barriers to entry for creating and operating a marketplace are substantially lower now than they've ever been before. And we have a little experience of this at Stripe, again, through the lens or the context of payments, particularly over the course of the last 4 or 5 years, as to what's kind of at play here. And we see this through the eyes of some of our very early customers. I've cited 2 examples here, Lyft and Shopify, who represent platforms or marketplaces, obviously in very different categories or different segments, for which those that had the first mover advantage and originally sought to kind of carve out these moats of technology as the basis for their competition, which made it harder for new market entrants to get established. So the barriers to entry actually back then were quite high. And what we've seen progressively happen over the course of the ensuing 4 or 5 years is that these barriers have started to come down. What we saw with Lyft and Shopify, by way of example, was that the things that they were both independently from each other grappling with when it came to payments and operating their marketplace, so the flow of funds that need to occur between when a consumer buys something and to making sure that a merchant or in the case of Lyft, the driver of a taxi was getting paid for it. The things that they were grappling with were almost identical, right? To the point where we felt that actually 80% of what they were grappling with through the lens of payments and through the lens of commerce was similar. And actually it was only kind of the 20% that sat on top of that was really the thing that was kind of differentiating one kind of marketplace from another in terms of what was unique about them and what their value proposition was or what set of customers they set out to serve. And so then, in our case, we productized this in something that you can see on the screen there called Stripe Connect, which over the ensuing number of years solved for these platforms all of the problems that they were independently trying to solve for themselves. And there's a range of them up there, ranging from anti-money laundering considerations and KYC considerations around knowing who their merchants who are operating on their platform might be, through to helping the sellers on their platform with simplified tax reporting. Indeed, as these platforms intended to increasingly go global, taking away the complexity that they were grappling with of having to integrate with banking and financial partners to make sure that money showed up in the bank accounts of the sellers on their platform in a predictable and a timely fashion. And so, to the point of how are platforms now having such outsized success and taking such a share of online commerce, fundamentally it boils down to examples like this, where those barriers to entry have really radically been reduced in recent years. And we see it in terms of the numbers. We see the success that marketplaces that are built on Stripe, because we see the processing volumes that are going through them. We see that on average they're growing by about 300% year on year, and a number of these are multi-billion pound companies that are operating at significant scale globally around the world in many countries, supporting all of the different payment methods that consumers in Europe versus Asia versus North America define as important means for paying for the services that they consume. Interestingly, in the case of marketplaces and platforms, the sell side of the platform actually, we found, is substantially more important for these organisations, perhaps counterintuitively, than the customer side of the equation. Potentially 10 times as important. In the area of kind of seller retention. The statistics that we've produced would suggest that for every 1% increase in seller retention on a platform or marketplace will drive a 10x increase in revenue than would the corresponding 1% increase in customer retention on the marketplace. So if you're in the marketplace and platform business, it becomes very important from a profitability and a growth perspective to focus a lot of resource on the experience that sellers on that platform might have. But that's probably a detailed topic for another day. So I think, what does that mean for I guess many of the folks sitting here in front of me today? I think the fundamental question to be asked actually here is, do you have a platform play? So if you're an e-commerce or a mono-brand retailer, that could take the form of potentially experimenting with, is there an opportunity for you to create a marketplace or a platform of your own? Or actually is the question more fundamentally one of, is there an opportunity for you to sell through existing platforms or marketplaces? And we've actually seen many traditional established retailers, I've cited 2 examples on the screen here, taking the former approach of starting to experiment with what it means for their businesses to establish platforms or marketplaces. In the case of JL or John Lewis, it's the establishment of their John Lewis Home Solutions platform, which is connecting John Lewis customers with tradespeople to help them with the implementation and the fitting and the installation of products and goods that they might buy from John Lewis, either in store or online. IKEA have done something similar with their recent acquisition of TaskRabbit, who are helping flat pack furniture customers with assembly and installation and so forth. So that fundamental question of do you have a platform play is one to be answered. We've also seen that retailers are increasingly starting to think like tech companies. So those that have decided they don't have a platform play, and again I've cited some up here, are really thinking along the lines of technology as the means for differentiation. And here we come back to the concepts of cloud and APIs and kind of mobile first. But also really thinking about their most precious commodity, which they readily identify as being developers and software engineers, the single most constrained or determinant resource, far more so than financial capital or the location of stores, because many of these don't have any, when it comes to their growth and their success. And so we felt there was something in this. So we commissioned a piece of primary research called the Developer Coefficient. Right, a slightly technical name, but to assess or to quantify the business impact that developers are having on the growth of organisations today. So we interviewed many thousands of C-level executives in about 30 or so industries around the world, and came up with some pretty strong conclusions. 71% of the CXOs we interviewed said that developers help bring products to market faster. I don't necessarily think that that's too much of a surprise. 70% said that they actually help to drive sales online, and this starts to also make sense when you think about checkout optimization and conversion and the role that the developers play there. Approximately the same percentage also said that developers help them to provide a genuine differentiation in the products and services that they sell, when compared to their competitors. I think maybe even more interesting, however, are some of these stats. 53% of the CEOs that we surveyed said that they're more concerned about access to developers than access to financial capital as a means for growth. So more than half the CEOs of many thousand organisations that we interviewed have this on their mind. And then the compounding effect of that, of course, is that 42% of them, 42% of the time of developers spent in these organisations is spent keeping the lights on. So maintaining legacy system, fixing bugs, rewriting bad code or bad software. And if you multiply some of these numbers out, it becomes quite striking to say that over the next decade, the quantifiable cost of this for the UK economy is, in the tens of billions of pounds. And indeed, if you multiply that out globally, then you're talking about some very significant sums of money in terms of lost productivity through developer inefficiency. So again, if there's a takeaway, to be had here, really it is about finding those scarce resources, but actually just as importantly, making sure that they're spending their time on productive tasks. So what does this all mean? I guess we're ultimately talking about the lower barriers to entry, greater productivity out of precious resources like developers as a means to kind of democratize commerce in terms of how that enables more platforms and more businesses to trade and transact online. Just like the web, in its first incarnation was all about, the 1.0 version was all about breaking down silos of information and, helping it flow, between the recipients. And Web 2.0 was all about, richer browsing experiences and this kind of shift to mobile. Web 3.0, as we think about it, really is about the web becoming, its fundamental role becoming kind of the backbone for modern commerce. And we see that as relevant in retail more so than perhaps any other industry or sector that's at play today. So to draw all of that together, to leave you with some takeaways, what does that mean? Work out if you've got a platform play, either creating one or participating in one. But this is the undeniable trend of where the proportion of online commerce is going. If you don't have one, don't despair, but think more like a tech company as you think about the proposition and how you bring your services and goods to market. And then developer centricity is key in the online commerce world. Whether it's, hopefully you aren't one of the 47% of companies who are more concerned about developers than capital, maybe you should be. I don't know. I don't know your business well enough to be able to comment on that. But the simple reality is there's a compounding effect there that it's hard to find good software engineers and developers, but just as important is making sure that they're productive and are working hard on kind of producing the new growth and business additive aspects of your proposition rather than just kind of keeping the lights on. I'm getting the wind up from time, so I presume I have maybe a minute or so left. So I'll say that I've got time for a question if anybody has one. But thank you.
Thank you, Ian. We do have time for questions.
Okay,
if anybody would like to use Slido or pop the hand up, and we've got a roving microphone around, which we'll get to. Actually, something that's interesting me, you're talking about large and small organisations having to future-proof themselves. Is it easier if you're large or if you're small?
The benefit for the small organisation is it's not encumbered by legacy. If you're starting with a blank piece of paper, you would argue that makes it somewhat easier.
Mm-hmm.
Having said that, if you go and speak to any small startup business, well, they would love to have a lot of what the large business has in terms of brand recognition and so forth. But from a pure technical perspective, I think it's harder for a large established business to find ways to unpick maybe the legacy that they built over decades and modernise and reinvent from that perspective. But we're certainly seeing them do it.
Especially, as you said, the barriers are now coming down
They
and
are.
the agility they've got.
Indeed.
Fascinating.
Okay.
Thank you very much.
Thank you
Thank you
again.
very much indeed.
My pleasure.